Welcome back to the Deep Dive, where we take your source material, your articles, notes, and reports, and really pull out the signal you need.
And today we're looking at a sector that sounds almost mundane on the surface, but it's fascinating.
It really is. We're doing a deep dive into the car washing center business in India.
Exactly. And the source material we have is this incredibly detailed market research and project feasibility report. And what it shows, really, is a blueprint. It's a blueprint for how a massive, highly fragmented service economy starts to formalize itself.
And it's happening right at the intersection of, intense urbanization, and this is the critical part, environmental regulation.
That's the key.
So our mission today is to uncover the specific financial drivers, the structural hurdles. We have to talk about water scarcity and the really high growth trajectory of this business.
Yeah, the numbers are impressive. It's projected at something like a 6 to 8.5% compound annual growth rate.
Right. We're basically tracking the shift from a quick, informal street wash to these big, organized, multi-crore franchise models. Okay, let's unpack this.
So to start, when we talk about the size of the opportunity here, you have to appreciate the scale of the Indian market.
It's massive.
It's huge. The report estimates the market was valued at somewhere between $885 million and $1.11 billion in 2024.
Just in 2024. I mean, that's already a substantial slice of the whole service economy.
It is, but then you put it in a global context.
And that's where it gets really interesting, right?
Exactly. The worldwide market for car washing is around $34.31 billion. So India, with its huge population and all those vehicles, it's only capturing about 2.6% of the global share right now.
That low penetration rate is basically a giant flashing sign that says growth opportunity.
That's the takeaway. The report identifies India as the fastest growing market in the entire Asia-Pacific region. They're projecting it could reach up to $1.87 billion by 2030.
So this isn't just slow, steady growth, it's exponential.
It's a step change.
And the source material is clear that this acceleration, which really seems to kick off around 2015, isn't just about more cars on the road.
No.
It's a fundamental shift in how the service is delivered. You're moving away from that, the traditional, highly informal, street-based guy with a bucket and a hose.
Right. To organized, technology-driven businesses using standardized equipment, proper processes.
So what's pushing that change?
Well, the report points to three forces all hitting at once. First, you have rising disposable incomes, so people can actually afford a professional service.
Oh, makes sense.
Second, urban lifestyles are just more and more time-constrained, so that convenience of a fast, reliable wash becomes a necessity, not some kind of luxury.
And the third, I assume, is just the sheer number of cars.
The massive and still growing urban vehicle population, it guarantees sustained demand. The consumer is absolutely ready for this.
Okay, that all makes perfect sense. Demand is there.
Yeah.
But here's the twist, right? The report suggests the factor that really decides who wins and who loses. It's not convenience. It's not even price.
No, it's about the management of one core and very scarce resource.
You're talking about water.
I am. Income and urbanization create the demand, for sure, but it's the regulatory pressure on water usage that is completely reshaping the competitive landscape. These water conservation mandates are acting like a fill core.
A filter that weeds out the old model. And the precedent is already there. The report points to cities like Bengaluru.
Yes, a critical example. They've implemented complete bans on using potable drinking quality water for commercial car washing.
And this wasn't just a suggestion, right? This was an enforced rule.
Oh, absolutely. Designed to protect a very scarce resource. And the penalties for not complying, they're high enough to change business behavior almost overnight.
How high are we talking?
Fines in these regulated areas can go from $5,000 all the way up to $25,000 per violation.
Wow. And to put that in context, $25,000. That's more than a street washer might earn in an entire month.
Exactly. So it effectively makes that old, wasteful, informal model financially impossible in the big cities.
So this regulation basically becomes a competitive moat for the organized players, the ones who invested in the right infrastructure.
Precisely. We're talking about high-tech water recycling and treatment systems.
And that investment creates a really high barrier to entry. I mean, these systems, they're mandatory for compliance, and they reduce water use by, 40 to 60%?
A huge reduction. But they require a big upfront capital investment. Typically, you're looking at 8 lakh to 25 lakh.
And just so you have a sense of that, 1 lakh is 100,000 rupees. So we're talking about 10 to 30,000 US dollars, roughly, just for the water system.
That kind of capital outlay
Yeah.
It just prices the vast majority of the informal sector out of the market overnight.
So you end up with this split market. You've got the unorganized sector, which still does most of the volume, maybe 65, 70%, charging low prices.
150 to 300, something like that.
But they're operating with this massive existential regulatory risk hanging over their heads.
Yeah. While on the other side, you have the organized sector.
Hmm.
They only have about 20–25% of the volume, but they're built on compliance, consistency, and higher quality.
And more importantly, they capture the higher margin business because they have the infrastructure to legally operate for the long term.
Exactly.
And speaking of those higher margins, let's talk about the different models within the organized segment. They aren't just selling one kind of wash.
No, they've diversified like crazy, following that consumer demand for convenience. The data from 2024 shows that the dominant model, in terms of revenue, is the fixed location rollover and in-bay automatic systems.
The ones you drive through.
Right. They
Yeah.
captured a huge share, 62.24%. They're all about high volume, standardized, quick service.
But the segment that's really growing, the one that signals the future of urban India,
Yeah.
it's the mobile on-demand services.
Oh, absolutely. They grew the fastest at 7.2% annually. And it makes perfect sense because they solve the ultimate urban problem, logistics. You don't have to go anywhere.
The service comes right to your doorstep.
Yeah,
And I'm guessing you pay a premium for that.
a big one. And that convenience is very profitable. These mobile services charge anywhere from 20% to 50% more than a fixed location.
Here's where it gets really interesting.
Yeah.
Because we have to move beyond just volume and look at profitability.
Yes.
That basic exterior wash, it accounts for most of the transactions, but the margins are thin. The average price is maybe 250 to 400.
And that gives you gross margins of just 15 to 20%.
Which, if you connect that back to the high capex we were just talking about.
You can't support that big investment on 15% margins alone. The report really hammers this point home, the critical role of high-value services.
So a basic wash might be, say, 300.
Yeah.
But the premium detailing services, they start at what, 1,000?
At least.
Yeah.
And the jump in profitability is it's astonishing.
Let's talk about that.
Well, premium detailing, so think interior upholstery cleaning, paint correction, deep sanitization, those services offer gross margins in the 40 to 50% range.
That's a huge leap.
It is. And
Yeah.
then if you successfully upsell a customer to a high-end application like ceramic coating,
Which can be expensive.
very. It starts around $3,000 and can go up to $8,000 per vehicle. And for that, the gross margins just skyrocket. You're talking 50 to 60%.
So the business model looks less like a simple car wash and more like a specialized automotive boutique.
That's a perfect way to put it. That diversification into high-margin services is the difference between just surviving and actually thriving.
So let's ground this in the financial reality of setting one of these up. We know the capex is high.
It is. For a basic to mid-sized compliant facility, and that includes land prep, the equipment, that all-important water recycling system, and working capital, you're looking at a total investment of 50 lakh to 70 lakh.
That's 5 to 7 million rupees, or roughly 60 to 85,000 US dollars. That is a serious barrier to entry for any small business.
It absolutely is. And it means you're taking on a lot of debt, which in turn means you need consistent volume fast.
Right. The report quotes experts saying that to get sustainable, healthy margins, you need a daily throughput of at least 15 to 20 vehicles.
Minimum.
But wait a minute. If the capital investment is so high, aren't you just trading one major risk, regulatory noncompliance, for another major risk, which is debt?
That's the billion-dollar question, isn't it? And the unit economics in the report, they answer it with surprising clarity.
How so?
The high initial capex is offset by a really low operational cost per wash once the system's up and running. Your labor is efficient, and your main input water is being heavily recycled.
So that operational efficiency is why the break-even point is actually pretty low compared to the investment.
Remarkably low. The analysis calculates that you only need to process 12 vehicles a day to cover all your costs, fixed and variable.
12 cars a day. And that translates to about 1,013,800 in monthly revenue.
That's your inflection point right there. Hitting 12 cars a day gets you safely into the green. But the real leverage of the model kicks in when you go past that.
So let's look at that sweet spot. What happens if you hit that target of 20 vehicles a day?
At an average price of $400 per car, you're generating an annual profit of over 11.76 lakh.
That's a phenomenal 47% margin on that extra volume above the break-even line.
Exactly. The difference between washing 12 cars and 20 cars a day, that's where you find the massive profitability.
Which brings it all back to those success factors the research identified.
Right. Number one, location quality. That dictates your volume. You need high traffic areas, affluent demographics.
Number 2, investing early in that water recycling system. It's not just for compliance. It's about lowering your operating expenses.
And number three, aggressive diversification into those high margin premium services we talked about. That's what boosts your average ticket price well above that 400 mark.
Now, in a country like India, you have to deal with major seasonality. The monsoons, for example, can just wipe out business for weeks.
Hmm?
How do these organized players handle that kind of revenue volatility?
This is where the financial model really starts to show its maturity. They're moving away from a purely transactional business, where you only pay when you show up.
They're embracing recurring revenue.
Exactly, subscription models. I see the data here shows these plans, say, $1,200 to $2,500 a month for 2 to 4 washes. They improve customer retention by a massive 40 to 50%.
And that gives you predictable cash flow, which has to be a lifesaver in a volatile market.
It is. It ensures revenue keeps coming in, even when walk-in traffic slows to a crawl during the monsoons. And on top of that, they mitigate risk through institutional demand.
You mean fleet and commercial contracts. So taxi aggregators, logistics companies, corporate fleets.
Precisely. Those contracts provide stable, guaranteed, high-volume business, and they account for a solid 8 to 12% of total revenue. That institutional backbone gives a lot of confidence to lenders.
And the bank loan projection in the report really spells this out, how a lender sees this risk. When they look at that initial Euro-LAC investment, they're focused on the ramp-up risk.
They absolutely are. Lenders use a key metric called the debt service coverage ratio, or DSCR.
Right, which basically tells them if you have enough cash flow to cover your loan payments.
It's their safety margin. And in year one, while you're still building volume and paying high interest, the DSCR is very low. It's projected at 0.28. The P&L even shows a net loss. Lenders get nervous at that stage.
But then the magic of the subscription model and the high margins starts to kick in pretty quickly.
Very quickly. The report shows that by year two, the DSCR jumps sharply to 1.31.
And that's above the key threshold.
That jump is the proof of concept. The acceptable level for most commercial lenders is 1.25. Hitting 1.31 by the second year confirms that the business model is robust enough to service its debt comfortably. It validates the whole thing.
So what does this all mean?
It means the entire Indian car washing industry is at this major inflection point. You have urbanization, convenience, and stringent environmental rules all pushing in the same direction.
Driving a shift away from a market that was, 70% unorganized?
To one that's defined by high capital investment, by technology, and by these specialized high-margin services. The old model is essentially being regulated and priced out of existence by the new compliant infrastructure.
And the final provocative thought for you to carry forward, which comes from the report's deep dive into compliance, is this. The future profitability of this whole sector hinges on engineering efficiency, not just elbow grease.
That's it exactly. The report makes it abundantly clear that mandated environmental compliance, like that big initial investment in a recycling system, it's no longer just a regulatory cost.
At a cost of entry.
It's the defining barrier to entry. And since water restrictions are guaranteed to expand to other cities, adopting sustainability first isn't a cost center. It's the primary differentiator for long-term success. The business that figures out how to use the least water is the business that ultimately wins the market.